Yes. Welcome to day 2 of Ind AS seminar on behalf of entire WNC and especially me, Ruta Chitre, who will be hosting your session today, and Chintan Patel, who is from Ahmedabad. He is the main coordinator of this entire program. So we'll be starting right now with motto song first. So please keep your hand on your heart when we hear this motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता
I think the voice is not coming.
mute पे हो.
Hello? Now is it audible? Yes, thank you. I'd also like to say that Chintan is also chairing the Ind AS committee, and it is very noteworthy that Ind AS has a lot of opportunities coming up, especially when it becomes applicable to the banking sector. So there is a vast amount of opportunities, and I feel that we must all make the best use of knowing and having studying this refresher course also. And our speakers, I'm sure that our speakers will be open to a number of questions. So Jaimin, I'm taking the liberty on your behalf and saying that yes, you will be open to all sorts of questions because the topics today that you are going to deal with are really complex. And before I introduce Jaimin sir, I'll request Chintan Patel to give his opening remarks. Chintan, over to you.
Yes, sure. Thank you so much, Ruta, for having a wonderful start of second day. Thank you so much, the faculty of the second day session, Jaimin Panchal, for coming and spending his valuable time. And thanks to my all participants, because even though Ind AS has been there since last more than 4 or 5 years, but still the zeal and enthusiasm of participants is such that we got around more than 200, 300 registrations on Ind AS refresher course. That suggests that this is a topic which is evolving topic. Every year IFRS changes and Ind AS changes. So Ind AS 115, Ind AS 116, 117, and then we are looking for some more changes which is happening, which is going to happen over the period. So it's really good to learn, refresh ourselves, and one of the most important thing, it is primarily focused on conceptual principle-based standard. Yesterday we have Yagnesh Desai, who has started the session with the first day, and he is focused on Ind AS 1, Ind AS 8, Ind AS 10. Today, Jaimin by faculty, he is going to focus on Ind AS 12 and 37. Out of these two topics, I will say income tax is still a very complex for accounting standards 22, but for Ind AS it is much more complex, because after more than 15 years of AS 22, if I ask somebody to do deferred tax computation, I'm sure in various SMPs it may be wrong. Now Ind AS 12 has a completely different concept, and that is very important. Somehow practically we are also applying that concept in AS also in practical scenario. But however, this is a very important learning for all of us, and we are eagerly here waiting to listen from the faculty, Jaimin bhai, and he has a very good experience. If you just look at all 8 sessions, we have extraordinary excellent faculty. They are expert of the topic. They have very good experience of working on Ind AS conversions, implementations, advisory, and every kind of possible situations as far as Ind AS is concerned. So we are sure that This course will be going to help with many important things, which includes a conceptual clarity one. Secondly, practical case studies and issues which they have already dealt with that I can also discuss. So not taking much time here, and now I hand over charge to Ruta for introduction faculty.
Thank you. This is my pleasure to introduce CA Jaimin Panchal. In addition to CA, he is MCOM and also is CFA level 1 from USA, CFA of USA, and it holds a diploma in IFRS ACCA from ACCA London. Jaimin has more than 13 years of post-qualification experience in advisory, having domain knowledge of technical accounting, F&A, managed services, financial and regulatory reporting, digital tools, and statutory audits. He is heading CFO advisory team for Gujarat, working with KPMG for more than 9 years, prior to which he was associated with EY and BDO International. He has wide experience working with clients across sectors such as telecom, infrastructure, and real estate, pharmaceuticals and chemicals, fertilizer, city gas distribution, oil and gas, tiles and sanitary, manufacturing, FMCG, and service industry. I think this covers really n number of industries across, and I'm sure you will benefit from your this such wide and vast experience. He is regular in taking technical accounting training sections for clients within India and also abroad. Ind AS workshops. He also he has a diploma in KPMG organized training for DIP IFR by ICCA, and he has also spoken at various CP study circles of ICAI as well. He has organized various workshops and also at other forums other than ICAI. Apart from this, this is very interesting. Apart from this, he is an avid runner, cyclist, swimmer, and he enjoys participating in triathlon and marathon races in India and abroad. He is 4 times finisher of Ironman 70.3 distance. So that's fantastic. I will say a healthy professional, great professional. So really, this is fantastic to have you here with us, Jaimin bhai. And over to you now for your presentation. Yes, yes, Sunil.
Yeah, before Jaimin speak, I think he has been inspirational for many professionals like us. And we had a fitness movement in ICM the branch, and he was one of the inspirational, motivational person who is guiding everyone, all professionals, please come out and do walking, jogging, and cycling. I'm also really inspired from his because he's a part of the board. I know the hectic atmosphere, a lot of pressure in before. Still, he has been able to spend time. So I think everybody can spend time. So we must learn something from him, and that's focus on fitness. And second very important thing before we start, generally for refresher course, certification is not provided. But a day back, there was a EC committee WRC where it was discussed, decided that for all refresher course, all participants who are having 90% attendance, they will get a participation certificate for a refresher course. So just announcement for everyone, if you are there for 90% of attendance as per the our virtually registered record, then you will be eligible for a certification for participation. With this, thanks to Ruta and thanks Jaimin, and hand over to you.
Jaimin bhai, before you start, a small question. While you are cycling, which Ind AS you think the most?
Sorry, why you're?
While you are cycling, which Ind AS you think about the most?
while I carry out my fitness activities, after 15 minutes I really go in a trance mode and I really don't think of anything else than myself. It's a meditation, I would say. It's a meditation. Yes. Okay, so thank you so much, Ruta, for the warm introduction, and Chintan Bhai. We have been, having a great deal of experience interacting earlier as well at the Institute Forum and various other forums. A warm welcome and a very good evening to all the participants today. And as for the agenda, we are going to discuss two important topics. One is Ind AS 12 and the other is Ind AS 37. Ind AS 12 is very practical, very conceptual in terms of applying the technical concepts. So far as the Ind AS 37 is concerned, again a little theoretical from the perspective of implementation, but again very practical, because we face a number of challenging situations while we really implement or make the provisions in the books of accounts while closing the books on a quarterly and a yearly basis. With that, I'll just share my screen. Give me a second. I believe my screen is visible.
Yes, visible.
Yes. Okay, so just a minute. Yeah, Ind AS 12 income taxes. So over the next one and a half hours, we are going to talk about the basic concepts of Ind AS 12, the income taxes. What are the key areas where we need to focus, how to deal with some of the practical situations, how to account for the various tax number in terms of current taxes and deferred taxes, which are the recognition principle, measurement principle, what are the disclosure and the presentation requirement, and that's the overall objective for the next one and a half hours. The general rule is very simple. On the face of P&L, we have to give the income tax number, and that income tax number is generally divided into two parts. One is the current tax and the second is the deferred tax. Current tax is nothing but very simple, the amount of income tax payable or recoverable in respect of the taxable profit or tax losses for a period. So the way the income tax provisions are, the computation is done from the Income Tax Act standpoint. What is the tax provision that the company really needs to make provided for in the books of accounts? That will constitute what is the current tax. It can be tax payable or it can be recoverable, as the case may be in case of there are losses in the books of accounts. Plus deferred tax is again the derivation from the two aspects. One is what is the current tax as compared to current tax as per the textbooks vis-a-vis what is the book tax from the books of accounts. We know that there are differences between the way the books of accounts are being written and the various transactions are being recorded and accounted for, vis-a-vis those transactions being treated differently from the perspective of income tax provision from the Income Tax Act standpoint. Because of that, there is a evident difference between both the amounts, and in order to match the number from the tax standpoint, we need to provide some deferred tax in the books of accounts, may it be deferred tax asset or a liability, as the case may be, and that overall becomes the current tax plus deferred tax equal to the income tax. So DT simply recognizes the difference between when an item is taxable and when it is accounted for. Recognition of current taxes is in the statement of P&L position. Current tax for current and the prior period should be recognized as an asset or a liability. Tax payable is equal to liability, and tax paid but recoverable is equal to asset. These are the very simple definition which is given in the standard. Tax assets may arise in some jurisdiction through the ability to redeem current period tax losses against tax paid in the earlier period. Recognition of current taxes are generally tag along with the underlining item where it attaches to. So far as the profit and loss is concerned, those current taxes which are recorded on the profit of the company or the loss of the company will be presented there at the face of the P&L itself, unless any tax related to the item which is accounted in the other comprehensive income or equity, as the case may be. So for an example, actuarial gain and loss, or let's say the FX, unrealized FX on the translation of the foreign entities, or revaluation of the property, plant and equipment, which generally goes and sit in the other comprehensive income, which is below the statement of P&L. The related taxes will go and sit with the particular line item. In case of the statement of changes in equity, let's say there is a compound instrument and related accounting treatment is different from the income tax treatment, the related deferred tax go and sit with the equity changes in equity itself. So the rule is very simple. So far as all the items from the P&L standpoint between the tax books and the accounting books will be presented and disclosed as a part of statement of P&L. and with related to items of OCI or equity, it will go and sit there. So it will tag along like a, I would say, generally I would say this is a Hutch puppy, when we used to have Hutch before the Vodafone. So it will tag along with the underlining item. Measurement of current tax, again I will not spend any time in discussing how the current tax is really calculated, because it it's totally different from the perspective of accounting, because I don't get into the taxation at this stage. We are purely talking about the accounting aspects, accounting concepts so far as deferred tax is concerned. What the standard talks about is the whatever are the your eligible, deductible or allowable expenditure in the income, taxable income, you apply the current tax, which is the applicable tax rate for the type of income. And those tax rates are the enacted or substantially enacted by end of the reporting period, which are applicable tax rates for that particular period. It could be general rate, which is the blanket rate. It could be specific rate like a capital gain tax rate, or it assume no distribution. So as the case may be, from the income tax law standpoint, whatever applicable tax rates are there, which are substantively enacted by the end of the reporting period for which we are reporting right now, would be applicable in order to derive what is the current tax. Now we talk about the deferred tax. Deferred tax, again, Ind AS book versus tax base will give you the temporary differences. Now these temporary differences are two type of temporary differences: deductible temporary differences or taxable temporary differences. What is deductible temporary differences? Are those differences arising from the transactions which are going to be deductible in future. Since they are going to deductible in future in the income tax, we are required to create a deferred tax asset in the books of accounts. And taxable temporary differences are those differences arising from such transactions which are going to be taxable in the future in the income tax, and hence we need to create a deferred tax liability in the books of accounts. Again, both the differences will be applicable for the tax rate applicable, the rate at which they are applicable, recently enacted taxable rate. Again, it will tag along with the profit or loss or OCI or equity, as the case may be. Goodwill is something different. I will take it specifically once I will go through some more slides. And by this identification of deductible and taxable temporary differences, we need to create a deferred tax or recognize the deferred tax in the books of accounts. Again, two types of deferred taxes: deferred tax asset and a deferred tax liability. Now, what is tax base? The tax base of an item is the amount attributable to that item for tax purposes. Very simple. A transaction which is recorded in the books of account as per the Ind AS, if the same transaction is being treated under the income tax differently, the way that item will be allowable as an expenditure, or it is deductible as an expenditure, or it is taxable. If the base is different, the amount is different between the Ind AS books and the tax books, that will create the deferred taxes. That base which is considered in the income tax or tax books is called the tax base. So tax base of an asset is amount deductible for tax purposes when the asset is recovered. So for an example, very simple, interest receivable of 100, the carrying amount. So what would have been done in the books of accounts is interest receivable account debit 100 to interest income credit 100. Now related interest revenue are taxed on a cash basis so far as the tax books are concerned. So in the Ind AS, what we have done is interest receivable account debit to interest income credit, but when it comes to the tax books, this interest is taxed only when it is actually received and not on the accrual basis. So in which case there is no entry to be passed in the tax books of accounts, and hence the base of tax is nil, because there is no interest receivable as an asset in the tax books, but it is there under the Ind AS books. And that is the difference between the books accounting base book base and the tax book base. Tax base of a liability: carrying amount less any amount that will be deductible for tax purposes in respect of that liability. So example is warranty provision of 100 carrying amount. So again, we have debited expense saying that warranty expense debit 100 to warranty provision 100. So we have created a liability, but this is deducted only when the claim is there by the customer, means on an actual basis. Again, the tax base is nil because in the books of the tax, this will not be considered as a liability, and hence the liability base under the tax books is nil. Now in both these examples, because the base, which is the tax base, and the book base are separate, are different, it will create a deferred tax implication in the books of accounts. We will see why this difference arises and what is the need for passing this entry so that we are complying with this deferred tax provisions. So this is a classic example to understand how this really function. So initial cost of building is $120. Useful life is 3 years. Tax, which is for the tax purpose, versus 6 years for the accounting purpose, and tax rate is 40%. And annual profit before taxes and depreciation is 200. So they have just we have just for the simplicity purpose assumed that. So for the next 6 years we have 200 profit before tax and depreciation. Now from the accounting book standpoint, I will depreciate my building over 6 years. So there will be 20 straight line basis depreciation for the next 6 years. Whereas in case of textbooks, the depreciation will be for the 3 years at a SLM basis, and it will be 40. Now let's say how the income tax is calculated. So in this one table, what we have done is we have plotted for the next 6 years the profit before depreciation and tax 200. Depreciation expense as per the accounting book is 20. So my profit before tax is 180. Now if I apply current tax expense at a 40%, it will give me 64 for 64 and 80. No, so basically current tax is basis the 200 minus 40, and basis that the current tax is calculated, and the tax that I'm going to pay on my tax books is 64 for the first 3 years and then 80 for the remaining period, because the tax base will be 0 after the 3rd year. So what will be the effective tax rate is nothing but the tax divided by the profit before tax. It will be 36% and 44% after the 3rd year. So there is a clear difference. Actually, the percentage of tax should be 40% in the P&L, but it is 36% initially, and afterwards it is 44%. And that is the specific reason why we need to still book something in my books of accounts, so that my rate of tax, effective tax rate, is near to 40%, and it should not have any difference of the tax rate. And this is the reason why we need to do this as a accounting. So this table shows that building tax base is 80 and 40 and 0 in the 3rd year. Building carrying amount is 180, 60, 40, 20 in the accounting book. So now these are the building tax, the first line, and the second line is the accounting base, which is the 180, 60, 40, and 20. So there is a temporary difference arises between the textbooks and the accounting books, which is 20, 40, 60, 40, 20, and so on and so forth. So we need there is a deductible temporary differences in future. So we'll have to create a deferred tax liability on the temporary differences with the rate applicable. So there is a deferred tax liability created on 20, 40, 60, 40, 20 for the next 5 years, and it is accumulated and it is getting reversed after the 3rd year, if you see here, and in the 6th year it is 0. So on the day 1, on the first year, we have created 40% on the temporary difference of 20, and the 20 is nothing but the difference between the tax base 80 and the book base 100. Similarly, in the 2nd year, it is the difference, temporary difference is 40. On 40 we have a 40%, so it's 16, and so on and so forth. So deferred tax expense is 8 in the earlier 3 years, and then it gets reversed in the subsequent 3 years. Now, if you see the current taxes, we have calculated current taxes here based on the income tax provision 64, 64, 64, 80, 80, 80, which is written here. And income tax expense will be the combination of both, the sum of both deferred tax expense or income and the current tax expense, which is 72, which is smoothened over the next 6 years. And now profit before tax is 180, the book profit, which is 180 here, and hence my effective tax rate is 40. Now, in order to answer the mismatch and to have the effective tax rate, is the answer creation of the deferred tax asset or a liability in the books of accounts. I hope this example is very simple and it is understandable to understand the basic concepts of why we need to create a deferred tax in the books of accounts. And I again repeat that the overall tax is the summation of deferred tax expense or income plus the current tax. Current tax will come from the provisions of the tax law, applying the tax rates specifically on the various items, the way they are allowable as an expenditure or taxable in the books, through which we make the provision for the tax, and that that will enable us to decide what is the tax base in the textbooks and the book base in the accounting books. The difference between both of them will give us the temporary difference. This temporary difference would be either taxable temporary difference or a deductible temporary difference. Basis we have to provide for the deferred taxes in the books of accounts. Now, few cases, let's say a machine cost $10,000 for tax purpose. Depreciation of 3,000 has already been deducted in the current and the prior period, and the remaining cost will be deducted in future period, either as depreciation or through a deduction on disposal. Revenue generated by using the machine is taxable. Any gain on disposal of the machine will be taxable, and any loss on disposal will be deductible for the tax purposes. So what is the tax base here? The tax base would be the, at this stage, is machine, which is 10,000 minus the tax depreciation of 3,000, that is a 7,000 is a tax base. The next is interest receivable has a carrying amount of 1,000, which is in the books, accounting books, and the related interest revenue will be taxed on a cash basis. Now again, this is very similar what we have just discussed. In the accounting books, I have a receivable of 1,000, but this receivable is not recognized from the tax standpoint because it will be recognized as a revenue only when it is received in cash. I mean, when it is received actually. That means there is no receivable, and hence in the tax books there is no tax base. Trade receivable have a carrying amount of 10,000. The related revenue has already been included in the taxable profit, right? That means the tax also recognizes this revenue on accrual basis, and hence the tax base and the book base is same. So trade receivable in the accounting book is 10,000. Similarly, the textbooks trade receivable is also 10,000. The next is tax base of liabilities. The first is current liabilities include accrued expenses with a carrying amount of 1,000. The related expense will be deducted for tax purposes on a cash basis. So again, there will be a cash basis accounting at the textbooks level, and hence the tax base is 0 so far as this current liability is concerned. The next is current liability include interest revenue received in advance with a carrying amount of 10,000. So we have created a liability as a revenue received in advance. The related interest revenue was taxed on a cash basis. In the tax books, this is taxed on a cash basis as the case. In this situation, we have already received in advance, but it is taxed in the textbooks, and hence there is a tax base and the book base is same. Current liabilities include, no, there will be a difference. In B, there will be a difference because I am not recognizing revenue in the accounting books, but I am recognizing this as a revenue in the tax books, and hence in the accounting books it is not considered for the current tax provision, but in the textbook it is considered, and hence it will create a deferred taxes. So it will be a taxable temporary differences in future. The C is current liabilities include accrued expenses with a carrying amount of 2000. The related expense has already been deducted for tax purposes. So again, there will not be any difference in the tax base. The tax base and the book base is same. The fourth is current liabilities include accrued fines and penalties with a carrying amount of 100. Fines and penalties are not deductible for tax purposes. So there is no tax base, there is a book base, but since this is not going to be allowed as a expenditure in future, being a penalty from the tax standpoint, and hence there is no tax base at this stage, but then there will not be any deferred tax to be created, kind of a permanent difference. Now in these two slides I was more talking about what is the tax base from the perspective of asset and liability, and not from the P&L standpoint. And this is the major difference or a gap between the earlier IGAP, where we used to calculate the deferred taxes based on comparing the statement of P&L line items versus what is given under the IFRS or Ind AS, which is the balance sheet approach. So the P&L approach and the balance sheet approach is totally different. Earlier we used to focus only on those line items which are considered as a taxable or allowable from the tax standpoint, and create the deferred taxes only on those line items, and ignoring what is the actual position from the asset and a liability standpoint. Vis-a-vis under the Ind AS IFRS, we have to see what are the tax bases from the asset and liability from the balance sheet standpoint vis-a-vis the accounting balance sheet. Because of this, there will be so many line items will be covered which were supposed not to be considered so far as the P&L comparison is concerned. And the classic case is again the revaluation reserve that we create, or the some of the transactions directly recorded at equity level, and so on and so forth. Right. So one of the major concept is under Ind AS IFRS, it's a balance sheet approach. We have to think and cultivate our thinking and concepts from the perspective that what will be the asset or a liability in the textbooks because of the tax provision, vis-a-vis what I have recorded in my accounting books so far as my Ind AS is concerned. If there is a difference, I have to see whether it is a taxable temporary differences or deductible temporary differences. Basis, it will determine that what is the deferred tax liability or deferred tax asset. Give you one more example. Let's say for the purpose of the property, plant and equipment, there is a revaluation model applicable, where I will say that the company has opted for fair valuation or revaluation model for their PP. Now whatever PPs that their property, plant and equipments they are fair valuing, definitely in the Ind AS books of accounts the value will be uplifted or undervalued, as the case may be so far as the fair value is concerned. Now because of this, there will be a corresponding difference arises so far as the tax base is concerned. Again, in the tax base books, this upliftment of the value or downward revaluation may not be available, and hence we are creating a difference which is again the tax base is lower so far as the PP balance is concerned, and the book base is higher, and this will create a deferred tax liability because it will create a taxable temporary differences which will reverse in future by way of depreciating these assets in the accounting books. And essentially what will happen that when we sell of these assets, or we are 100% utilizing these assets in future, this will start reversing it. So in a way it will reverse because of the time gap as well as the depreciation created over the period in the books of accounts, but ultimately at a point in time it will be either fully utilized or it will be sold off. At that time the tax treatment will trigger, and because of that the difference what we have created today would have already reversed over a period of time. So this is a classic case, and most of the industries have considered this type of deferred tax impacts in the Ind AS books of accounts vis-a-vis the earlier IGAAP books of accounts, where people used to say that there is a permanent difference between both of them and we are not going to recognize any deferred tax liability on the same. The next slide talks about the carrying value is equal to the tax base. Essentially, they are saying that there is no difference between both the bases. If that is the case, then we are not going to create any deferred taxes. Ind AS 12 gives the following examples or circumstances in which the carrying amount of the asset or liability will be equal to its tax base. Accrued expenses which have already been deducted in the determining an enterprise's current tax liability for the current or earlier period. A loan payable is measured at the amount originally received, and this amount is the same as the amount repayable on the final maturity of the loan. Accrued expenses which will never be deductible for tax purposes, and accrued income will never be taxable. I spoke about these differences will be temporary differences. Again, two types of differences, but when it comes to permanent differences, that means the difference arises today between the two bases, and this differences will never be reversed in future because of the because the way the treatment is given in the textbooks, considering the tax laws. It will create a permanent difference, and if it creates the permanent difference, there is no requirement of creating any deferred taxes. Temporary differences, taxable temporary differences, that will create the deferred tax liability, because you are going to get pay the tax on it, on this temporary differences in the future. So you have to create a liability in the books of accounts today. If you are creating deferred tax liability, the corresponding debit is a deferred tax expense that will come and sit in your statement of P&L as a deferred tax expense. Deductible temporary differences, again, it is going to be deducted in the future, and hence you can create a deferred tax asset today. It is a deferred tax asset debit, so the credit will go to deferred tax income. It's part of P&L in the credit side. So this is a simple chart to understand what will be the temporary differences and whether it will create a deferred tax asset or a liability, which I just explained. These are the typical temporary differences. Let's say marketable securities or the investment that we have made in the securities, the quoted securities, recorded at a fair value of financial statement purposes, generally recorded at historical cost so far as the tax purposes are concerned. We fair value all my investments in the equity securities as per the Ind AS 109 financial instruments, and this will definitely create the deferred tax in my books of accounts. Allowances for the doubtful accounts, again, whatever provision that we are creating vis-a-vis whatever write-off that we have to create in the books vis-a-vis what is allowable in the income tax is not the provision or allowances, but for the actual write-off. It will create a deferred tax implication so far as your carrying value of the trade receivable is concerned. Property, plant, equipment, again, because of the depreciation method or the change, different useful life, or fair valuation is taken care in the books of accounts, which is not considered in the income tax at the time of some of the business combination, some of the scheme of arrangement, or probably fair valuation is allowed from the income tax standpoint, but not in the accounting books because of the common control transaction accounting. Then again, it will create the deferred tax implications in the books of accounts. Pension liability or the actual gain and loss that we talk about, or retirement benefits, again, whatever provision that we need to make under the relevant Ind AS, which will not be the same number so far as the textbooks are concerned, and hence we have to create the deferred tax on it. We can work around on this example. PPE with original cost of 150. Accounting treatment is depreciate straight line to zero residual value over 5 years, and tax treatment is original cost deductible straight line over 3 years. Now, because of 5 years and the 3 years different in the useful life, I will have a lower base of PPE in the books of accounts vis-a-vis higher base in the accounting books vis-a-vis the lower base in the income tax. Now, because of that, I will have to create a deferred tax liability because I will have a taxable temporary differences in the books of accounts. So accounting carrying amount is 120 on the after the end of the 1 year. Tax base is 100 because I am accelerating my depreciation so far as my tax books are concerned. So the temporary difference in the year end one is 120 minus 100 is 20, and on this I will apply the percentage of current tax and create the deferred tax liability. The next is the deductible temporary differences. Restructuring provision of 100. Accounting treatment is expense as per the Ind AS 37. Tax treatment is tax deductible upon reversal when actual expense incurred. Now, because of this, I'll not be able to make a provision in my tax books of accounts. So my accounting books 100 provision as a liability. In my tax books, it is 0. So tax base is 0 and accounting books is 100. So far as a liability, I will get this as a deductible temporary differences in future, and hence I need to create a deferred tax asset today on 100 multiple with my tax rate. Again, applicable tax rate is the enacted or substantively enacted by end of the reporting period. Okay, deferred tax asset or liability in the books of accounts are not like a long term or a short term. They are not bifurcated into any, and it is not subject to any discounting as well. For all your items on the P&L, the recognition of deferred tax will go in P&L so far as expense and income is concerned. So far as the items related to OCI or equity is concerned, it will go and sit with the particular OCI line item or equity. I dealt with that just in the initial slides. And if because of the business combination, there is a deferred tax implication arises at the time of business combination, then this deferred tax asset or a liability which we create on a day one of the acquisition accounting, it will be actually go on reducing the goodwill, and hence goodwill is net of deferred tax asset or liability of all the assets and liabilities that it has been acquired. Because of this, what will happen that the goodwill is always a remaining number, and on this goodwill there will not be any deferred tax to be created. So as to say that the goodwill in the accounting books and the goodwill in the tax books, if there are difference, then we have to create a deferred tax. The question is no, because it will create a loop in the accounting books. So far as the goodwill derivation is a residual number, it's a remaining number. If you create on a goodwill deferred tax, it will again subsume in the goodwill only. So it's a kind of a loop, and hence the standard talks about that on goodwill at the time of business acquisition combination accounting, you don't have to create a separate deferred tax on the goodwill. But overall, whatever assets and liabilities have been acquired as a part of the business combination, those are definitely subject to assessment of the deferred tax, and we have to create a deferred tax separately on each line item being assessed on the date of acquisition. These are the typical line items on OCI. It's revaluation gain or loss from the PP standpoint or fair value through OCI. So those financial assets which are fair value through OCI or liability fair value through OCI, foreign exchange differences on translation of foreign entity, a cash flow hedge account. If you are following hedge accounting under Ind AS 109, I would say it's Ind AS 109, not 39. Ind AS 109 for the fair value of OCI, then those deferred tax is going to be part of the OCI. And where it is equity, like compound financial instruments or share-based payment, where the ESOP reserve is created for that matter, considering it's an equity settled ESOP, etc., then it will tag along with the equity statement of changes in equity. When there is a situation of taxable temporary differences, we have to create a deferred tax liability. It will be created in full. So they'll not. So while we make the assessment, when we know that there is a taxable temporary differences, the deferred tax liability will be created in full. The corresponding debit will go to deferred tax expenses. But when it comes to asset creation of asset, again the the concept of prudence and the conservatism. It says that recognize if it is recoverable. Now when I say it is recoverable is when it is likely to reverse in future. Now that reversal of the deductible temporary differences arises only on the condition that those items will have a base in the future, in a near future, which will be reversed. And if it is recoverable, probable, then only you will create the deferred tax asset. Otherwise, you can restrict the deferred tax asset creation to the extent of deferred tax liability. So this line item, unlike deferred tax liability, a deferred tax asset is recognized in respect of deductible temporary differences only to the extent that it is probable that taxable profit will be available. So one is either I should demonstrate that there will be a taxable profit in the future, which is enough, which will reverse my deferred tax asset created today, and it will create the deferred tax temporary differences so far as this asset which has been created, or against which the deductible temporary differences can be utilized, right? So if there is a specific item for which there is a specific treatment, for an example, short-term capital losses can be set off against the long-term capital gain only. I'm giving hypothetical example, in which case if it is probable that there will be a capital gain in future against which the deferred tax asset I have created on a losses today can be reversed. In that case, the probability will be assigned, and basis if it is more than 50% of the probable probability, then I will create the deferred tax asset, otherwise I will not. So that's the rule so far as the Ind AS 12 is concerned. This was virtual certainty was a word earlier considered under the IGAP, which has been now considered as a probable or recognized if recoverable or reasonable recoverability. That actually creates a difference between the gap between the IGAP and the Ind AS IFRS, and I would say that it will be a little liberal in terms of creating the deferred tax asset in the future. Having said that, the demonstration has to be there in terms of whether there will be enough taxable profit or deductible temporary differences arises in the future that can be utilized. Deferred tax assets can be created on the deductible temporary differences, unused tax losses and unused tax credits. Again, taxable temporary differences should be there in future, taxable profit should be there in future, tax planning opportunities are there. So if you can demonstrate that there are enough tax planning opportunities where this difference is arising today, deferred tax asset will be reversed in future, and then carry back of the income can also be possible in the future. So somewhere down the line, the management has to demonstrate, document, come up with the concrete plan in terms of the tax planning, considering the tax laws in the country. Again, a good example to understand. These are the basic examples to understand the concept. So we don't complicate this with various other aspects that come in our mind from the perspective of income tax provisions. So company A is having a DTA of 100. It forecast payable profit for taxable profit for 3 years is 500. So again, they demonstrate that there is a taxable profit very much sufficient, and hence they can recognize the DTA of 100. The B company is having a different situation. They have a DTA of 100 situation where the forecast taxable profit for the 3 years is minus 200. So then in the next 3 years, they are not having a good probability of creating the taxable profits, but losses, in which case being prudent and conservative, the DTA cannot be recognized. And in case of company C, the DTA is 100 and the forecast taxable profit for the 3 years is 80. Now here again it is subjective and judgmental. Again, from the perspective of company, they may demonstrate with some more tax planning and all, and they create the 100 as a DTA, but at the max they can create the deferred tax asset to the extent it is going to be reversed till the 80 profit is probable. So they can restrict their DTA to the extent of 80 and not fully 100. Now, these are the guidelines available and some of the evidences that the management can produce in order to establish that in future we will have a probability to reverse this deferred tax asset which is created today. The positive evidences could be existing contracts or a firm sale contract, or the present order book that they have in terms of their business, or cumulative earnings in recent years, long carry forward or carry back periods from the tax standpoint, history of utilization of carry forward before they expire. So in past they have already done this because they have an effective tax planning in place, availability of feasible and prudent tax planning strategies. So if these are the few things which can be demonstrated by the company, by the management, then maybe the call could be taken again based on judgment that deferred tax asset could be fully recognized in the books of accounts. The negative is, yes, they are expecting losses in future, cumulative losses in the recent year. They don't have a history, or there are existence of the loss contingencies and so on and so forth. So from the disclosure standpoint, we have a detailed disclosure required from the perspective of revised schedule 3 as well as the way Ind AS 12 is concerned. From the presentation statement of P&L, will have a income tax portion where it will be divided into two parts: is the deferred taxes, which can be income or expense, and the current taxes, which will sum up and come as outer column. Deferred tax asset and liability will be separately disclosed in the statement, the balance sheets, and related deferred taxes with respect to OCI item or the equity item will be shown separately on that phase. There will be a detailed disclosure so far as the movement of deferred tax asset and liability is concerned, given as a part of the disclosure. There will be a proper reconciliation given for the effective tax rate between the book tax and the actual tax, and what are the reasons for the difference between the effective tax rate and the actual tax rate. This is the elaborative disclosure which will be required from the perspective of the Ind AS 12. The key learning again is from the perspective of conceptual clarity, where we say that what is the tax base and the book base. Again, it is from the balance sheet standpoint, asset and liability. Taxable temporary differences will create the deferred tax liability, and the deductible temporary differences will create the deferred tax asset. The effective tax rate reconciliation is important. The current tax rate is important at what is to be applied for considering the tax laws. And the most important is the whether I can recognize the deferred tax asset fully or not. The key difference between IGAAP and IFRS or Ind AS, I have dealt with this while I was talking about it. The major difference was IGAAP and Ind AS was the virtual certainty vis-a-vis the probable certainty or reasonable certainty of creating the taxable taxable profit in the future. With that, I end Ind AS 12. But having said that, I have few practical case studies to dealt with from the ITFG. So let's go through 4 or 5 case studies. I'm just sharing that right away right now on my screen to bring more practical perspective. Issue 79 of this ITFG bulletin is talking about that what happens when there is a tax holiday under section 80 IA and IB. Now earlier under IGAAP AS 22 there was a ASI applicable, ASI 3, with respect to situations covering for the tax holiday under 80 IA and IB, which was dealing with that, if within the tax holiday period those temporary differences are capable of reversal in that period only, then you don't have to create any deferred tax in the books of accounts. Whether the same situation or the treatment will be continued so far as the Ind AS 12 is concerned or not, that was the question here, where the ITFG committee come up and said that since this is the Ind AS 12, it does not cover the ASI 3 directly, and hence it can't be used directly, but considering the provisions of Ind AS 12, the treatment would be similar what was discussed as per the ASI 3, and hence the final conclusion was that the deferred tax in respect of temporary differences which reverse during the tax holiday period is not recognized to the extent the entity's gross total income is subject to deduction during the tax holiday period as per the requirement of 80 IA and IB of the Income Tax Act 1961. So that is very simple and clear from the perspective of tax holiday period. The next is a situation where a business combination is there. So let's go through this. A Limited has two subsidiaries B and C, and it required to comply with Ind AS from 1st April 17. In August 15, B and C got amalgamated. Maybe this is the amalgamation through the court approved scheme. And there was a goodwill which has been created in the separate financial statements of the amalgamated entity, which is B and C. The entity has decided not to restate the past business combination. So under Ind AS 101, they would have opted not to restate the business combination. If they would have restated the business combination, their accounting treatment would have been totally different. Again, this is again a common control type of transaction, yet they have a goodwill created, because I presume this is the court approved scheme, and hence there is a again ITFG bulletin specifically dealt with situation where it mentions that when there is a court approved scheme, the accounting treatment mentioned in the scheme which is approved by the court or NCLT will supersede the treatment given in the Ind AS 103 business combination. So the goodwill is created in the books of accounts, but at the time of this goodwill is allowed as a deduction under the income tax law in the books of the amalgamated entity. In the consolidated financial statements of A Limited, such accounting goodwill gets eliminated as a result of consolidated adjustments. However, there is an increase in the tax base of the assets in the consolidated books of A Limited, resulting from such tax deductible goodwill. So the question is whether deferred tax asset on the tax deductible goodwill should be recognized in the consolidated financial statements of A Limited prepared as per the Ind AS when there is no corresponding accounting goodwill in the consolidated financial statements of A Limited. Now, before we go through the answer here, I want to clarify one thing. Is earlier under the IGAP, at the time of consolidation of various entities, all the subsidiaries which are consolidated in the parent company, whatever deferred taxes are created in the respective subsidiaries are line by line added and accounted for so far as the concern, and there was no specific deferred tax treatment given because of the consolidated adjustments, which is the gap difference from the IGAP to Ind AS IFRS, where Ind AS IFRS says that at a console level also you have to identify if there are temporary differences arising because of the console adjustments, and hence you have to create the deferred tax on the same. Secondly, it also mentions that if there are undistributed profit, accumulated profit in the books of subsidiary, then whether that is also subject to deferred taxes or not, because once they will distribute the profit as a dividend or something, then anyways it has to create the tax provision, and because of that assumption they say that whether you need to create a deferred tax asset or liability in your books of accounts on this undistributed profit or not, that was also a question, and where the answer was positive. Yes, you have to deal with those type of situations so far as Ind AS is concerned. This was never considered when the IGAP was applicable earlier. Now in this situation, what they are saying is, because there is an amalgamation of B and C Limited becoming a separate entity, in the books of B and C there is a goodwill created. This goodwill is considered as a taxable in the tax books. From the consol books of A Limited is concerned, when the B and C is consolidated, this goodwill is eliminated as a part of the consolidation adjustment, and hence there is no goodwill in the consol books. How to deal with the treatment so far as deferred tax is concerned in this situation? I'll straight away go through the answer. Deferred tax asset on the tax base of goodwill should be recognized in accordance with Ind AS 12 by creating the crediting the consol statement P&L to the extent that it is probable that the taxable profit will be available against which the deductible temporary differences can be utilized in the consol FS of A Limited. So from the consol A Limited financial standpoint, since the goodwill is not there in the books of A Limited at a consol level, but the goodwill is deductible at the amalgamated entity level. It creates the differences, temporary differences, and hence in the consol books it mentions that you have to create a deferred tax in the consol P&L. Additionally, this will not qualify for the initial recognition exemption under paragraph 24 of Ind AS 12, as there is no initial recognition of an asset or liability arising from the amalgamation of subsidiaries in the consol. This is a separate thing. So ultimately it mentions that yes, at a consol level you have to create a deferred taxes. The next issue is with respect to DDT, dividend distribution tax. So let's go through this scenario. P Limited holds 100% equity shares of S Limited. So parent holding 100% in the S Limited, which is the subsidiary. During the year 16, S Limited paid dividend of 1 lakh to P Limited and paid DDT of 20,000. What would be the accounting treatment of DDT in the consolidated financial statements of P Limited? The second is, would the answer be different if P Limited in turn pays dividend of 1.5 lakhs to its shareholders and DDT liability thereon is 30,000? Now we know that DDT liability against it can be set off basically at a parent level. As per the tax laws, DDT paid by S Limited of 20,000 is allowed as a set off against the DDT liability of P Limited, resulting in P Limited paying 10,000 only. Since P is receiving dividend on which the DDT was deducted by the S Limited and against which the P is anyways giving dividend to its shareholders, for which it has to pay the DDT, as per the tax laws, this can be set off at the P level, and hence the liability in the P Limited is incremental 10,000 only. So what will be the situation of deferred tax implication in this situation? And the third question was whether DTL on the accumulated undistributed profit of the subsidiary company is required to be recognized or not. This is something which I just explained. I will again reiterate, but let's go through A and B answer first. I'll straightway go to the answer. In the consol FS of P Limited, the dividend income earned by P Limited from S Limited and dividend recorded by S Limited in its equity will both get eliminated as a result of consol adjustment. DDT of 20,000 paid outside the consol group, that is to the tax authority, should be charged as expense in the consol financial statements. So that's the accounting treatment. So the 20,000 which has been paid by the subsidiary for the dividend distributed to the parent is paid to the tax authority. It is outside the group transaction and hence it is an expense in the books of P Limited. So in the consol P&L, it will be a DDT expense. The second is if DDT paid by subsidiary S Limited is allowed as a set off against the DDT liability of its parent P Limited as per the tax laws, then the amount of such DDT should be recognized in the consol financial statement changes in equity of parent P Limited. Accordingly, in the given situation, DDT of 30,000 separately, okay, 20 of S and 10 of its own paid by P should be recognized in the consol statement of changes in equity. The basis for such accounting would be that due to parent P Limited's transaction of distributing dividend to its shareholders and the related DDT set off, this DDT paid by the subsidiary is effectively a tax on distribution of dividend to shareholders of the parent company. Hence, it is nothing but distribution of the reserves of the subsidiary to the parent, and hence it will be accounted in the equity so far as the DDT of 30,000 is concerned. And the last question, they ask for the undistributed profit. Now, from the undistributed profit of the subsidiary is concerned, we know that the control definition under Ind AS 110. So when you will go through the Ind AS 110, the consolidation standard, they mentions that what is the subsidiary, and there the definition of control is given. Now, when a parent has a control on the affairs of the subsidiary, that means parent knows that whether I am going to distribute this profit for as a dividend to the shareholders or not, so far as that subsidiary is concerned, and that is controlled by parent. Now, in which case, if parent demonstrate that I have a control 100%, and I don't have any intention, neither in the past I have actually distributed dividend, and hence there will not be any DDT liability at arisen so far as the present situation is concerned, and hence there is no DDT. Since there is no DDT, I don't have to create any deferred tax on the undistributed profit at the time of consolidation of my subsidiary in the parent company's books of accounts. If that is possible, then only you don't have to create any deferred tax on the undistributed profit of the subsidiary. Otherwise, you have to create. In otherwise, if there is a past experience or past distribution by the subsidiary, you don't have a full control like 100%, but let's say because of the de facto control, like de facto control is what is, let's say I hold 40%, 60% is it's a listed entity, and 60% is distributed in millions of shareholders. So by 40%, yes, I control, but I can't control 100% decision so far as the dividend is concerned, right? So in which case I cannot demonstrate that I'll never distribute the dividend. Then in those situations you can't demonstrate that they'll not be subject to deferred taxes. So that is also one of the very important point, and a lot of the companies have taken the impact of deferred taxes at a consolidated books of accounts. The next is very interesting and very debated point, which we dealt with a lot of companies, and then it was also given by the ITFG as a part of the clarification. So companies have freehold land, and generally we know that the freehold land, when it is sold, it is subject to indexation benefit, and if it is indexation benefit is there, then the tax liability on the capital gain would be accounted calculated accordingly. So the cost is actually added as an indexed cost, and the sale consideration is compared with that, and whatever is the remaining is subject to tax. But so far as the books of accounts are concerned, it is carrying at the cost only. So now what is happening here is that while I apply the Ind AS on the first day basis, I have a carrying value of my freehold land which is at a cost. Now whether that is subject to deferred tax or not, is the tax base of this freehold land in the textbooks is different or not. So the assumption goes here is that if I sell the freehold land today, then how the tax is calculated from the income tax standpoint, which I just said. If that is the case, then the tax base is totally different than my base which is there in the books, which is at a cost. The difference on which I have to create a deferred tax, because the assumption is that in future whenever I will sell it, I will anyways catch up the difference between both of them, and I will have to pay the tax, and hence it creates the temporary differences. Since it creates the temporary differences, I have to create the deferred tax in my books of accounts. That's the concept. Many companies used to make an argument saying that, see, I can't sell my freehold land alone. Either I can sell with some of the other assets as a slump sale, or I will utilize this freehold land for my business purpose. In which case, this will not be subject to capital gain. It will not be subject to, rather it will not be subject to indexation benefit, and hence there will not be change in the base. Since there is no change in the base of the tax and the accounting books, I'll not create any deferred taxes. That's exactly what is given by the ITFG, and a lot of companies have taken this call in their books of accounts while transitioning from IGAAP to Ind AS. Okay, so I think that's it. Some of the key important practical issues also I wanted to cover, which I have covered. And with that, I just close and end the first session on Ind AS 12. If we have any questions, I can take it up, or else we can move for the next session. Before that, we can also break for 5 minutes, but before that, if there are any questions, I can take it up.
तो क्वेश्चंस है 1 मिनट सर.
Yes. If there are no forecast taxable profit for future period and DTA is not created, whether an appropriate note should be given in the notes to accounts? Yes, you end up giving a appropriate note in the financial statements. Generally, the accounting policy also mentions this type of situation. Cost of investment in mutual fund INR 20 lakhs. Valuation of the above investment at a fair value through P&L is 21.5 lakhs. This gain on revaluation is this investment wherever sold will be taxable under capital gain and will be taxable as a long term or short term as the case may be. As on reporting date, how do we calculate the deferred tax on this gain? So you'll have to, at the reporting date, you have to see whether this will be a short term or a long term first of all. If at the date of reporting, the valuation and the cost, the difference is falling under a short term, you'll have to create the deferred tax applying the applicable short term tax rate only. Unless you fall under already, carrying it on a long term basis already, then you'll have to apply the specific rate for the long term basis.
इतना ही था.
नहीं था, ठीक है, okay. So I think should we break for 5 minutes, a bio break?
So आपको चाहिए तो ले लो, no issues.
Yeah, we'll just break for 2-3 minutes and then we'll resume. Yeah. Hi everyone, I'm back. So I think we can start for the next session. And the next session is on, is on Ind AS 37, provisions, contingent liabilities, and contingent assets. Now this topic, if you see, is quite verbose in terms of the concept and the way it has been written. But at the same time, we know that there are very good practical implications and impacts so far as the accounting is concerned. And there is always a difference of opinion in terms of whether we should make the provision or we should, do the contingent liability disclosure, or it is more of an accrual, or it is liability, and so on and so forth. Having said that, it is always good to understand the concept while applying this this topic. This is a short topic, may not require so much time to really delve in, but I would just go through the slides, understand, give the understanding on the concept, give you some practical scenarios, and then I think it will be more of an interactive session where I would propose and expect that you give a lot of queries on this. Okay, so that's the expectation I set so far as Ind AS 37 is concerned. So while we go through this, again, the learning objective is very clear. We want to understand the concepts. We want to understand the concept in such a way that we can apply these on our practical situations and issues, and also deal with the disclosure requirement. Okay, the scope, yes, applies to all entities wherever they need to make any provision or disclose the contingent liability or asset, as the case may be, resulting from the executory contract. And the executory contracts are those contracts where the parties have performed their obligation partially or fully, as the case may be, and in which case you have to make the accounting in your books of accounts. Many specific cases are dealt with by various standards, like insurance contract related provisions are under IFRS 4, financial instruments 109, employee benefits again 19, construction contract again, I mean, this is not there right now. It is Ind AS 115 so far as the revenue related or construction contract related is concerned. Income taxes, so again, we just gone through so far as the deferred tax asset or liability is concerned. Leases, the treatment of deposits or treatment of the financial liability that will be created from the ROU asset model accounting standpoint, and business combination where there are n number of things are discussed in terms of while we do the combination accounting, what are the treatment in terms of contingent liability or in terms of unidentified asset or liability, or in terms of the restructuring cost or any provision that we need to create, etc. But otherwise, all other cases will fall under the scope of Ind AS 37. These are the key definitions. So overall, it is a liability. Now, what is liability? Liability is a present obligation from the past event expected to result in an outflow of resources. So very simple. I have received some services. I have used some of the goods. I have used some of the services, which is the past event. I have a contract which I have signed before, which is the past event. I have committed for that, for the payment, or I'm going to pay because I have received services or the goods, which gives me the present obligation as on today date, and hence it creates a liability in my hands. That is the liability. Accrual is a little different. Accrual starts with liabilities to pay for goods or services received or supplied but not yet paid or invoiced, right? So liability we know, but now what is accrual is liability. It is already a liability. That means it already has a present obligation. It is already from the past event and there is an outflow expected, but It's a liability to pay for goods or services received or supplied but not yet paid or invoiced. I have not made any payment, or I have not invoiced. I have not received the invoice, but I have received the goods or services, for which I may have an amount determinable or I may not have an amount determinable, but it is accrued. Accrued in terms of the performance. The performance has been done. Services has been given, like audit services, accounting services, outsourcing services, maintenance services, right? Goods have been provided, goods have been received by me. Those are the accrued liabilities, right? And the next is the provision. Provision, again, it talks about the liabilities of uncertain timing or amount. So I'm not sure about the timing when it occurs, or I'm not sure about the amount, but it is liability already. Electricity expense, I have already received the services. I have already had a past event of getting the services. I have a present obligation. There will be outflow, but I have not received the invoice and I'm not sure what amount it will have. It may have X amount plus, X amount minus, but not sure which exact amount it is there, and hence it is provision. So the difference between accrual and provision is the uncertainty of the amount majorly. In all this, both accrual and provision, if you see, it is a subset of the liability, and ultimately it is a liability, right? So accrued interest that we accounted for, provision for audit fees, we always mention it's a provision, but it is actually accrual, because we know the fees number, we know that the services has been provided, okay, and the amount is going to be paid in future. The amount is also majorly determined, right? So that's how the definitions so far as liability, accrual and provisions are. There are two types of obligations. One is a legal obligation and the other is a constructive obligation. Legal is out of the contract law or legislation, which company is obliged to in terms of the contract. When the performance happens by both the parties, both are obliged towards each other for their contractual obligation. And constructive obligation is nothing but it may not be written, it may not be documented anywhere, but because of the pattern or past event or past experiences, it is assumed by the parties to the contract or parties involved. So like for an example, every Diwali time the bonuses are given by the entity to the workers. There is no policy, there is nothing like a mandate or announce, but it has been a customary practice by the entity to give the Diwali bonuses. That becomes a constructive obligation. What standard says that if there is a legal obligation, you have to assess under the provisions Ind AS 37. If it is a constructive obligation, again you have to assess it under this and make the provision for. Like the vicinity of the industry where or the factory building or your corporate which you maintain from the perspective of cleanliness or from the perspective of growing trees, etc., then that becomes a constructive obligation. You have been doing it, you will continue doing it. So at the year end, if there is an estimated amount, you should provide for it as a constructive obligation. Identifying provisions generally required categorization. So provision for litigation. Now litigation is again very important to understand. There will be a lot of questions around this, or certain situations are dealt with at the time of year end where legal opinion is also required, that one entity is not agreeing for making payment of to the another entity. Again, it's a question of a law, question of in whose favor the decision can come. It is under arbitration, it is under any court of law. So whether we need to make a provision or it becomes a contingent liability becomes a big question at the year end. In this type of situation, we will deal with it. How to give a treatment in the books of accounts. Provision for warranty is very important. In the automobile industry, in your air conditioning industry, for an example, right? All the durables, they give the warranties. Now there are different types of warranties. One is a service warranty or a regular warranty. Generally, it comes like 3 years warranty is a norm so far as the automobile parts are concerned. So it's a normal and a regular warranty. There is an extended warranty where the above and over and above the normal warranty, the extended warranty is given. Now this warranty is also go hand in hand when Ind AS 115 revenue recognition is to be discussed. There also this question will arise that if at the time of sale of a product or goods, if there is an extended warranty, what is the accounting treatment from the revenue standpoint? And if there is a regular warranty, whether it will be a separate performance obligation or not. When it's a separate performance obligation, you have to account it as a deferred revenue. And in case of extended warranty, which is beyond the normal warranty, then you have to identify what is the amount and you have to create a liability for that, which is nothing but a provision for warranty. It's a deferred revenue, and that exactly dealt with under Ind AS 115, and hence those cases will be dealt under 115. This standard also coincide with the same requirement, and hence there is no difference. There is a parity between both of them. But when it comes to the normal warranty under 115, it will not separately consider it as a deferred revenue, but it will come under Ind AS 37, and it says that if you can estimate the amount, how much probable the chances where you have to serve these warranties by way of any damage or repair, etc., then that estimated amount from your past experience has to be accounted as a provision for the warranty, and this will be specifically under Ind AS 37. I hope that is clear. The next is provision for environmental obligation. Now, asset retirement obligation or decommissioning liability are the other synonyms so far as this terminology is concerned. Now, the apt case is where the land is taken on a lease or a building is taken on a lease, and the clause is there in the lease contract which mentions that at the expiry of the lease contract you have to make the property as is basis the way you have received at the time of inception of the contract. That means whatever you have made as a changes in the property which you have taken, building or land, etc., you have to make it good. Many companies who are into chemical manufacturing, fertilizer manufacturing, or a windmill or power generation, where the land is taken on a lease and the factories are set up, they are prone to a lot of land pollution and all, and they mention even mining industry for that matter. There's a lot of decommissioning cost to be accounted for in the books of accounts, which was not done earlier under IGAP majorly. So this was a major change while moving from IGAP to Ind AS for this type of industries, where they had to make a provision for the asset retirement obligation. The accounting is also mentioned in Ind AS 16, property, plant and equipment. Property, plant, equipment mentions about when there is a decommissioning liability, then asset retirement obligation is required to be accounted as an asset in the books of accounts at the time of capitalization of the particular PPE. The corresponding credit will go as a liability. How to recognize that liability is given under Ind AS 37, which mentions the entire concept of creating the asset retirement obligation decommissioning liability by discounting the cash flows and account on a day one. The next is provisions for the loss orders or onerous contract. So we will discuss this onerous contract. What do we mean by it by way of an example in the next coming slides. And provision of restructuring cost, when there is a restructuring happening in the organization where they are shifting one factory to the another location, or they are shifting the employees from one location to another. So there are a heavy restructuring cost is incurred. And with respect to that, what type of provisions to be accounted in the books of accounts is dealt with by this standard. The next is the definition of contingent liability and contingent assets. Very important. Contingent liability is an obligation of sufficient uncertainty that it does not qualify for recognition as a provision unless it is assumed in a business combination. So see here, if you see in the first slide, accrual and provision starts with liability, and liability is the present obligation which is required to be accounted in the books of accounts. So your trade payables are the liability. The goods are received, services are received, invoices are received, it are accruals or liability as the case may be. The invoice is not received, but from the PO standpoint, we know what is the amount. Those are accruals. We know we have received the services, we have received the goods, we know the amount which is almost certain, may require some adjustments to that. We don't know exact adjustments, etc. are the provisions. But in this contingent liability standpoint, it mentions it could be an obligation of sufficient uncertainty, because they are saying it's uncertain, it's sufficiently uncertain. That does not qualify for recognition as a provision unless it is assumed in the business combination. What is business combination? Let's keep it aside right now. I will deal with it at a later stage. Then it mentions that the uncertainty may arise from any of the following reasons. Now, what are the reasons or the circumstances in which this uncertainty arises? It is a possible obligation, it is a present obligation, or a probable obligation. Okay, so what is possible obligation? That is one whose existence will be confirmed by the occurrence or non-occurrence of uncertain future events, not wholly within the control of the entity. For example, if an entity is jointly and severally liable for an obligation, then the portion of the obligation that is expected to be met by other parties is as an example of a possible obligation. It may fall yes, it may fall no. We don't know. It is totally uncertain. So we are at a 50% or less than 50% of the situation. We are almost less than 50% of the probability, where we say that it is contingent on occurrence of either someone will do or someone will not do, and hence it becomes a possible obligation. If it is a possible obligation, the percentage is less than 50% of the probability, then it can be considered as a contingent liability. It is a present obligation. The next, but it is not more likely than not. More likely than not is very important. More likely than not is equal to 50% or more than 50%. That probability that there will be an outflow of resources embodying economic benefits, so that the probability of an outflow is 50% or less. An example is a claim against an entity when the entity concludes that it is liable, but that is likely to defend the case successfully. So more likely than not is more than 50%, not more likely than not is less than 50%. If it is less than 50%, then it will be like a possible obligation. If it is a likely possible obligation, then it is a contingent liability. If it is more than 50%, it will take a color of provision. And the next is, it is a present obligation, but its amount cannot be estimated reliably. These cases are expected to be extremely rare. Okay, so what is contingent liability? Occurrence of its events or non-occurrence of certain events which is out of the control of the entity, which are either possible or they are probable, but the probability is less than 50%, and hence it could be a contingent liability and not the provision, and for which the disclosure will be required. And contingent asset is the possible asset arising from a past event to be confirmed by future events, not wholly within the control of entity. So again, this is very clear. If it is possible, again, possible is more than 50%, but in that case also it is not wholly within the control of the entity, and hence you can't do anything, right? And from the prudence standpoint, you can't recognize that as a contingent asset in your books of accounts. Now we deal with the recognition criteria of the provisions. We know what is provision. Provision is a present legal or constructive obligation as a result of past event and the probable outflow of economic benefits to settle the obligation, and obligation can be estimated reliably, right? So the example is goods received, services received. So past event has been done. I know I need to make a payment in future. So economic benefits is going to be an outflow, for which the amount can be estimated reliably, and hence I need to make a provision. So these are the three criteria basically. The criteria for contingent liabilities: there is a present obligation resulted from past payment. However, outflow of resources is not probable. Not probable means less than 50%, or reliable estimate can't be made. Second, if it is a possible obligation, depends on future event, outflow of resources is probable, reliable estimate cannot be made. In either case, it is a contingent liability and you need the disclosure only. If it is totally remote, then we don't have to do anything. Contingent assets: possible assets more than 50% arising from past event to be confirmed by future events not wholly within the control of entity. Like for an example, I have put a claim for my insurance, which may be positive, may not be positive, I don't know, it is not in my control. Then can I recognize that asset? It can be, a probability is there, but I'm not sure, then no, I can't. But if it is virtually certain, now virtually certain in my example is like, if they have already accepted my claim, there is a document for that, or they have confirmed on email or something, then I can recognize if it is virtually certain as a asset. If it is probable or not probable, you just have to disclose it. Okay, I have made a claim and I may have a this much as a receive. If my claim is gets approved, then this is the amount involved into it. It's just a disclosure. And if it is not probable even, you don't have to even disclose it in your books of accounts. So very simple. Contingent liability, based on probable, you have to disclose it in detail. If it is more than 50%, okay, you have to make a provision, because then the reliability is there, the estimate, you can estimate the amount, then you can create a provision. If you can't estimate, then you can't make a provision for it. And the third is, if it is a remote liability, contingent liability, then you don't have to disclose it, which are very rare case or situation where the auditor will also agree to it. And the second is the contingent assets. Again, three situation: if it is virtually certain, then only you can recognize, which is again a very rare case. If it is a probable, again more than 50%, but it is a contingent asset which is outside your control, you can disclose it. And if it is not probable, means less than 50%, don't have to do anything on the contingent asset standpoint. Again, this judgment is required to be applied. Virtually certain is generally more than 90%. Probable, more likely than not, is the terminology used in the standard. 50% is very loosely used in various publications and even the standard. Even the education material also mentions that probable definition is more than 50%. Possible is generally less than or equal to 50%, and remote is less than or equal to 10% from the probability standpoint. So let's say we have already recognized a provision. Now when it can be de-recognized? So provision are generally utilized and used on the basis of the usage. We have incurred the cost, we will book the cost or the expense against the provision in the coming period. Then through the use of those provisions, the de-recognition of the provision will happen. Otherwise, through the revision of the estimate, like actuarial, employee benefit related, pension related, or the after retirement related provisions that we create, it generally catch it up as per the fresh assessment estimate that we do at the year end. Measurement at the time of creating the provision. The measurement is the best estimate that can you do at the present situation and the circumstances and the condition in which it applies. So it's a best estimate by the management. If it is a large population of similar item, then expected value can be derived with some statistics model, and probability can be arrived, which can be applied, and the amount can be derived for the purpose. While measurement is done, so far as the provision is concerned, some of the important aspects to be considered: if it is a long-term provision, long-term in nature, you have to create the proper discounting for the same. You have to appropriately choose the discount rate and book it at a present value today. If also considering the provision amount, you have to apply any factor to be considered from the risk standpoint, credibility risk or the liquidity risk, FX risk, inherent risk, uncertainties that require to be captured. For the reimbursement standpoints, let's say you are creating any provision, but you feel that there will be some expected reimbursement that I am going to receive it. If it is virtually certain, then only you will do the net off. Otherwise, you will do the gross accounting only. And expected gain from the disposal of assets should not be recognized as a reduction of the provision. So these are the few rules given in the standard itself, that while estimating and measuring the provision, you have to take care about all these things in your mind. A very simple example, let's go through this. Company A sells a product with 1 year warranty. Number of items sold is 1 lakh and cost to repair one item. If it is a minor defect, it is 10, and if it is a major defect, we have to give 40. So there is a warranty of 1 year, and based on the warranty, if there is a minor defect, the company has to pay 10. If it is a major defect, they have to pay 40. Based on the past trend and the statistics, this is a no defect are the 75% chances. So on 75% of their goods sold, they will not create any warranty provision, but they have a minor defects of 20% and the major of 5%. So very simple. They will apply the percentage of probability. Now again, this probability that they have derived is based on their past trend and past experience. So you need the statistic data from the client in order to derive this probability, and multiply with whatever cost that they need to incur. The resultant number is the amount of the provision that they need to create in their books of accounts for the defects of the warranty. The second is the measurement of a provision for a lawsuit. Information provided by the legal advisor. So many times when the situation or the case is under arbitration, or it is under a various court of law, then the legal counsel's advisors opinions are received, whether what is the probability of winning in our favor, what is the probability of getting settlement, what is the probability of our outflow or losing the money out of that case. So basis the estimate of the provision is required to be done. There we have to be very careful. If I have a positive opinion where probability is more than 50% of winning, and not have winning chances are more than 50% and there will not be any outflow, then probably you will not consider that at a provision level. You may just show it as a contingent liability standpoint, at considering the legal opinion. In any case, you are saying it is less than 50%, then you will make a provision. Again, appropriate amount of provision is required to be made, again based on opinion from the legal counsel, whether the settlement will happen of the estimated amount which is less than that, or whatever claim that the company has made to the law, to the court, will be accepted by them or not. Basis you have to make the provision. If it is a totally gone case, lost, there is no option for us, then you have to make the full provision. In case the court order has been received at a lower court level, okay, for an example, let's say session court has given or a tribunal has given some judgment which is against the company, which make the company to pay to the agreed party, and company is taking a call to go for a higher court or higher authority, in which case you have to be very clear with the management that what is the probability of winning in the higher court. Again, legal opinion is required. With that, if there is a positivity around of winning in the higher court, you may not provide for, but again make it a contingent liability disclosure and appropriately dealt with. Even if the company is going to the higher authority or higher court, possibly they are not sure, in which case you have to make a provision for being a conservative side. That's the overall concept so far as the legal suit, lawsuit or legal cases are concerned. But again, each case is required to be thoroughly examined, discussed, and then applied the concept to derive to a judgment whether a provision is required or a disclosure is required as a contingent liability. This is just an example of discounting basically. So this is a long-term provision which they have created in the books, this provision is going to be actually for the after 2 years. So they have discounted and created a provision on today, and this will be further compounded year on year. So this is a very simple example. Some of the specific conditions, they say that prudence is not the ultimate virtue, so do not provide for. So future operating losses or rainy days, like for an example, you know that I'm going to have losses in the future because of XYZ reason. That doesn't mean that you will start making provision of future probable losses that going to be there in the books, right? Then currency risk, we know that there is a risk so far as my exposure is concerned to the USD, etc., or maybe the current war is going on with Ukraine situation. I know that I'm exposed to the big risk, but then doesn't mean that I estimate today. I can't estimate as such, but then I make a provision for. Political risk, again, is external factor. Maintenance or refurbishment of the own asset. I can't right now really estimate that after 5 years I will do some maintenance on this asset so that I create a provision today. That is different situation. The situation generally dealt with under Ind AS 16 PPE is the componentization, where we mention that if there are a regular interval the cost is incurred for refurbishment of the asset or proper maintenance, that overhaul that happens, then on the day one when it is incurred, that becomes a separate component. It is depreciated over that particular period, and then every elapse of that period the amount is incurred or the provision is created. That is different than this. So they say that on estimate basis you can't make a provision of refurbishment or overhaul expenses. General restructuring projects and the general business risk, you can't make provision. So prudence is not the ultimate virtue. That's what the caption is here. Onerous contract. Now what is onerous contract? Any contract, if I terminate or I continue honoring the contract, in both the cases I have to end up incurring the cost, and and that cost is more than my economic benefits. That is a onerous contract for me. I don't want to continue with this contract because I have an alternative available. Still I have to continue because the contract is such, and I continue because of the contractual termination conditions becomes burdensome on me. I have to incur losses, which becomes an onerous contract. So it says that unavoidable cost is more than economic benefit, becomes the onerous contract. A classic example is that I have constructed my own office. I have taken an office which is rented right now. As per the rent agreement, it is a non-cancelable, and it's still a year to go for me to terminate the end the contract. So either I continue the contract or I will make a huge termination penalty payment and terminate the contract. In both the cases, I have to make either of the payment. Either I continue paying the rent or I make the payment of the termination penalty. Whichever is lower becomes my unavoidable cost, which is more than my economic benefit, because I have already a place where I can shift my offices there. So that's where the standard says that if it is an onerous contract, you have to make a provision for the amount which is unavoidable cost. So the example here is present obligation under the onerous contract should be recognized as a provision. Measurement is at the lower of cost of terminating or net cost of continuing. So either I continue or I terminate. whichever is the case, whatever is the amount which is lower than both the amount becomes my provision amount in the books. This is an example. I read for the benefit of everyone. The division of an entity operates out of leasehold premises. The lease is a non-cancelable 5 years lease. The annual lease rental is 1.5 million. So for the 5 years, I have to pay 1.5 million every year for the lease rental. The landlord is not prepared to discuss an early termination payment. Okay, so it's a non-cancelable and the landlord is not ready for termination. I am ready to terminate because I have an alternative available. Following the closure of the division, it is estimated that the entity would be able to sublet the property from 1st April 14. The entity could expect to receive a rental of 3 lakhs for a 6-month period and annual rental of 5 lakhs post that. So now what is happening situation is that I am discontinuing one division which was taken on lease. I have to continue making payment of the lease rental because the landlord is not ready to terminate it. And the second side is I have to, I can't use this, so I am subletting it. Now by subletting it, I am receiving some rental, which they have given here. So they are saying that I'm going to receive some rental against which I'm going to make the payment of some rental. And there is no termination clause given, which says the penalty, because there is no termination that can happen in this situation. So then I have to make a provision of this become as an onerous contract because I'm not going to use it for my purpose. I am closing down my division. At the same time, I'm receiving less amount by subletting it compared to what I'm paying. In which case, the difference of both the amount I have to create as a provision. They have given the discounting rate at a 5% for 1, 2, 3, 4, 5 years. Okay, let's see what they have done. They said that I'm going to receive 1.5 15 lakhs 1.5 million with the discount rate of 4.32 initially for 1 year, then 3 lakhs for the 6 months and 5 lakhs for the rest of the period which I'm going to make a payment for. What is the difference is this 45 lakh 10,000 is the amount of provision that I have to create. So the expected net cost of fulfilling the contract that I'm going to pay over 5 years, which is 15 lakhs into 4.32 discount compound rate, minus whatever is the cost that I am going to recover by subletting it. The difference is the total loss that I am going to create over 5 years is the onerous contract loss. I have to make a provision today considering the onerous contract provisions under Ind AS 37. The next concept is the restructuring cost. Restructuring provisions require detailed formal plan or binding sale agreement. Restructuring is nothing but closing down one division and shifting that to the another location, or employees are being relocated. Major business changes basically, where they say that when there's a restructuring plan being discussed or approved by the board, you have to see whether you have to create any restructuring cost or not, where the standard mentions that you have to demonstrate the commitment that there is going to be a restructuring happening in your business, and hence what is the amount at which you have to create a provision for. Entity must illustrate a demonstrable commitment by either starting or implementing the plan or announcing its main features to those affected. Mere board decision may not be sufficient to create the provision for the restructuring. Application: business or part of the business concern, principal location function, and approximate number of employees who will be compensated for termination, timing of implementation. These all are the plan related aspects to be demonstrated by the management. Then only you will qualify to create a provision for restructuring, not otherwise. And what amount you need to provide for is the unavoidable cost and not associated with ongoing activities. Means the new activities that you are going to conduct for the restructuring that is done, those related costs can be provided for. And you have to exclude any retaining or relocating continuing staff. So you may provide bonuses to the staff to retain them, or you provide relocating bonus, etc., or you create some marketing cost, development cost, or you make some investment. Those related costs are not required to be considered for the provision under the restructuring cost. It can be normally expensed out. The next example is repairs and maintenance. I briefly touch upon the overhaul cost. The classic example of overall cost generally I gave is in the shipping industry, the big vessels and the ships, their surface is required to be, refurbished every 4 or 5 years. It is called the dry dock cost. What they have to do is the entire vessel, a huge vessel, has to come to a dock, kept there for some really good time, and do the entire refurbishing of the down surface, which incurred a huge cost, without which the functioning of the vessel or the ship will not be continued, and it will prone to various other risks. So this is a regular cost that they have to incur, which is called the dry dock cost. And what the PPE standard says that this type of cost, once incurred, it is considered as a separate component. It is depreciated accordingly based on the life of the particular component. This standard says that this type of costs are recurring in nature every 5 years or 3 years, as the case may be. By estimating that amount after 5 years, you can't create a provision today and capitalize in the books. Once you will create it, anyways, you will book it as a PPE, and credit will go to anyways as a cost, right? But you can't make a provision accordingly. So future repair and maintenance cannot be considered for the purpose of your provision. And that's what brings me to the end of this session so far as provision, contingent liability, contingent asset is concerned. Again, as per the revised schedule 3 financial statements, we have to give a proper movement of opening balances, what is provision made during the year, what is the utilized, and the closing number. Again, it is divided into current and non-current. For the long-term provisions, discounting is required, for which you have to provide the judgment disclosure in the accounting policy, as well as what is the rate is considered. Asset retirement obligation is very important concept from the PP standpoint, as well as from the provision standpoint, for which judgment related provision will the accounting policy will also come, as well as the detailed disclosure will come. To sum up the key learning, again the definition so far as the accrual, provision, liability is concerned. Contingent liability, contingent assets, majorly if it is a more likely than not, which is the less than 50%, which is not possible or a probable, then you don't have to create any provision. If it is more than 50%, more likely than not, then you have to create the provision. In case of contingent liability also, if it is less than 50%, you may not have to give a disclosure, but in all circumstances you will end up giving the disclosures. If it is more than 50%, you may have to make a provision for the contingent liability as well. Contingent asset is very simple. Disclosure is required only when you are having more than 50% of the probability. Otherwise, no disclosure is required. Virtual certainty is a very remote chance, required to be assessed case by case basis. IGAAP did not consider any onerous contracts related situation, whereas IFRS Ind AS is requirement, which we discussed at length. IGAAP did not talk about any discounting, but IFRS Ind AS talks about discounting for the long-term provisions. Restructuring provisions was not considered under IGAAP specifically. Again, it was based on the legal obligation, but there is a specific guidance under IFRS and Ind AS. Contingent asset disclosure not permitted at all under IGAAP, but under IFRS Ind AS, disclosures can be given based on the guidance provided for. And that there are no further differences between Ind AS and IFRS, and that's where I end this session. And since it is a small topic, very conceptual, it was a short topic and short session, but I can open up the forum for the question answers. Vaibhav, are you there? Hello?
Hello?
Yeah. Yagnesh? Is the chat enabled? I think, let me see if I can enable the chat. I'm not sure I can do that because I can't see any chat here.
आपको chat दिखा है sir?
Hello?
Hello?
So I'm saying that the forum is open for the questions.
तो देखिए अभी आपको वो दिख रहा है सर क्वेश्चन? हेलो
Hello.
सर आपको ये क्वेश्चन दिख रहा है सर?
Let me try. I'm not able to extend it.
सर क्वेश्चन ये है सर?
I mean, the window where I can see the question is not expanded. I don't know how to do that. I'm a little new to this webinar software. Can you just, someone can copy the questions and share it here?
सर आपको क्वेश्चन दिख रहा है सर?
नहीं, I can't see the questions here.
सर अभी आप वहाँ पे क्वेश्चन बॉक्स में देखिए ना सर, जो गो टू वेबिनार का जो पैनल है ना, तो वहाँ पे क्वेश्चन बॉक्स में देखिए क्वेश्चन आपको दिखेगा सर.
Just a minute. So one question is from Sandeep Kunte. Can I create a reserve where a provision cannot be made? Example, currency risk, collateral risk, etc. No. Considering your risk profile in future, you can't create the provision first of all. But creating a reserve is something is something which is totally different, isn't it? You will have to look at the Companies Act also, that is this something for which you can create some reserves or not. To my mind, I have never seen any company creating any type of such reserve, saying that in future I will have some risk exposure of political or the currency. So the answer is no. To my mind, answer is no. Cost of investment mutual fund, okay, I dealt with that. Hope the presentation will be shared on email. Yes. Hope the presentation. How does one deal with an ex parte tax assessment order where basis of liability determination are unknown? Sorry, I'm not clear about this question. How does one deal with an ex parte tax assessment order where basis of liability determination are unknown. Okay, so from text standpoint, you are saying that the assessment is done by the authority on their own, where basis of liability determination are unknown, we don't know, but then they will be giving the amount, right? And they will be giving at least where for what they are asking you to make the payment of the tax. Okay, now in which case again I will go back to my basics of either you are going to further appeal against it at a higher level or not. If yes, and the probability is where you will be able to defend, etc., you will not create the provision, you may show it still at a contingent liability. If there are no forecast taxable profit for future period and DTA is not created, whether an appropriate note, yeah, I dealt with that question. In example of onerous contract, example of provision of this is it to be distributed over 5 years? No, that was a present value today, it will not be distributed. That is the present value of the loss on today's term, which will be debited at a cost and created as a provision in the books of accounts. It will not be distributed over 5 years. Is deferred tax required to be created for proposed share buyback in the books of the company? I doubt any proposed buyback will be really accounted some differently, which will create some deferred tax implication on that. Is deferred tax required to be created in the books of holding company? In the books of holding company for proposed buyback, again same question. It is requested that faculty goes a bit slow while oh, I'm so sorry. I'm not sure which example I can run it again. If Simarjit is still there, you can still write. I can run that example again. It was a wonderful session. Thank you. Mishraji, can you please share the PPT? Okay, I will share this PPT to the institute. Not able to hear. Request to share the. Okay. Very well explained. 1, 2, 3, will this slide be shared? Yes. Will we get the study material using the. Okay, so I think these all are the questions I have answered. Alternatively, you can reach out to me. I'll again share the screen. Wait for giving you my contact detail. Okay, you can note down the contact details. Just a minute. I hope my screen is visible. So you can reach out to me for specific questions that you have, not only on these two indices, but any other indices or from the accounting standpoint. And I am happy to interact further on this forum or otherwise. And thank you so much, Institute, for giving me this opportunity to give my views and thoughts on these important topics. And all of you, thank you so much for giving being here and patiently hearing me out my views and thoughts, and also making it interactive and asking questions for the same. I will end my session here. Thank you so much, and over to the coordinator. Okay, thank you so much.